by DJ Sour and Mr. Easy. Okay, so this morning we're talking, we turn our attention to a very bold move by the Bank of Ghana. Now, in just 2 months, the central bank has cut its policy rate twice, bringing it down to 21.5%. Now, on paper, that's supposed to make loans cheaper, businesses more attractive, and also households a bit more relieved. But the question many are asking is very simple. Will this cut really translate into lower lending rates on the ground? That's a very big question. I mean, that's what they're asking. Now, inflation has cooled to 11.5% in August, which is the lowest in almost 4 years. And the economy grew by 6.3% in the second quarter. The CD has also been relatively stable, even though it hasn't been quite, it hasn't been stable in the past few days anyway. Now, the Bank of Ghana believes the time is right to ease, but as history has shown, commercial banks don't always pass these cuts on quickly or even fully. And that is why this morning we're talking about this. We're not just looking at the numbers. We want to understand what this means for you and me, for businesses trying to survive, for young entrepreneurs who are looking for credit, and also for households struggling with loans. And to help us unpack all of this, I am joined by Dr. Frank Bannor. He's a lecturer at GIMPA, and he's going to help us break everything down this morning. We're looking at the opportunities, the risk, and also whether this bold move can truly bring some relief. Doc, good morning. You're welcome to the Business Breakfast on ZED.
Good morning to you, and good morning to your listeners.
Right. Thank you very much for making time to speak to us this morning. Let's get into the conversation. Now, maybe we can start from here. So for people who are listening to us this morning who may not follow policy closely, what exactly is the policy rate and what does it even matter for ordinary people?
Okay, thank you very much. So when we talk about the policy rate, or what is popularly known in Ghana as the monetary policy rate, in short called the MPR, in other jurisdictions it has different names, but in Ghana we call it the monetary policy rate. Now, essentially, the monetary policy rate is the rate at which the central bank, which is the lender of last resort, lends money to commercial banks in Ghana. So you know that banks in Ghana by themselves don't mint their own money or don't make their own money. They rely on the Bank of Ghana, in this case the BOG, which will be what I'll be using to get money. So when the Bank of Ghana, when the commercial banks in general, so when we talk about commercial banks, we are looking at banks in general that undertake trade, they give loans, they charge interest, and they make profits. So the name commerce, it translates into commercial banks. So when they take these monies from the central bank or the BOG in Ghana, well, here we are talking about the BOG. The BOG charge them a rate, or let me say it literally as what we would have called an interest rate. So this rate at which the BOG is giving money to the commercial bank so that they can equally lend it out to you and I, or consumers, is what we call as the monetary policy rate. So anytime the BOG wants to more or less target inflation, or in other sense, tighten the macroeconomic output of the economy, it tends to increase the monetary policy rate. What it simply means is that if the monetary policy rate is going up, then the tendency for commercial banks to take money or borrow money from the BOG becomes low, in other sense, because if you take money from the BOG, you intend to pay more. And for that matter, if you are paying more and you are also coming out to give this same money to consumers, then you also have to charge consumers more, and then consumers indirectly will be dissuaded from taking these loans, and for that matter, will reduce total aggregate expenditure and reduce inflation. So that is why the MPR is a tool that is used to target inflation. Now, on the other hand, anytime, like you rightly articulated, when inflation is easing, and especially when it is easing within expected threshold, then there is also the tendency to reduce the MPR. In other sense, the BOG would want to ease or expand economic activities, or would want to induce people to spend. And so by doing it, then reduces the price that it gives money to the commercial bank, because interest rate is the price for money. So when I use price, that is what I simply mean. So the price at which it gives this money to the commercial banks, so that the commercial banks can also give it at a lower interest rate to consumers, so that consumers will be induced to borrow more. So essentially, in terms of the monetary policy rate, that is how the monetary policy rate operates within an economy. Now, looking at the broader impact, as you asked earlier, that would a reduction of the MPR, in this case, we've seen the BOD reduce the monetary policy rate by about 350 basis points, which is equivalent to about 3.5% from 25% to 21.5% last week. Now, what does this mean for the ordinary consumer? Now, in a well-structured economy, and I'm using my word carefully here, in a well-structured economy,
right.
I mean, anytime the NPR is reduced, it has the propensity to induce spending. In other words, people are incentivized to borrow, because now you can get capital from banks at a very cheaper rate, which simply means that people can borrow to spend. So all things being equal, given the economic scenario, given a perfect economic scenario, it is expected that any time the monetary policy rate comes down, commercial banks are also obliged to reduce their rate at which they give money. That is what we call the lending rate. They are obliged to also reduce it. However, in an economy like Ghana, in most economies in sub-Saharan Africa, like I heard you make that point, and that is very true. It is you don't really see that happening, or you don't really see a corresponding decrease in terms of the lending rate as far as a declining monetary policy rate is concerned. Now, why is this so? Now, it is very critical to understand. That's why I use the word the structure of our economy. Now, one of the things that banks in general consider in giving out loans to consumers is the risk level. So, a situation whereby banks are not certain of your risk level. So, in other words, it is assumed that we are all high risk. Now, in a situation whereby you are all high risk, like the case of Ghana, because, for example, until recently that we have the Ghana card and then the digital ID property address system, if you even go to a bank and you are asked to fill a form, you would normally indicate that, oh, I live by that big tree behind that river at the other side of the city. Or, oh, there is this school called so and so just close to my building. But you realize that in reality, there is no, the school is actually not that close to where you live. So this creates risk. And because banks are not certain that once they give you this money, given the high risk that you exhibit, you would return the money, or you would pay the money with interest on time, they are forced to charge you a higher premium for the fact that you are high risk. So you see that in most cases, if you want to look at the data very well, you remember somewhere between 2017 and 2018, if I'm right, I think between that period to 2019, we have the NPR coming as low as about 13.5%. But you realize that banks were still giving loans at around 20-21% thereabout, if you remember. So, and it was at the same time that we have one of the lowest inflationary rate under the Fourth Republic. That is where we have an inflation rate of, I think, about 7.3% or so. That was in 2019. Yes. So ideally, you would expect that given such low inflationary rate and also given an NPR of about 13.5, you would ideally see banks or commercial banks giving loans to people around maybe 14, at most 15%. But that was not the case. That was not the case specifically because of the risk factor, which we've still not figured out as a country to eliminate from our banking system and eliminate from our macroeconomic jurisprudence. So if you are considering the economic dimension of monetary policy, then given the current reduction in the rate, it is expected that commercial banks will reduce their policy. But however, like the point that I have reiterated, given the risk level of many consumers within Ghana, and banks are not really assured of the fact that you may be able to pay back these monies. And in fact, the data also supports this claim, because if you look at the non-performing loans over the years, especially last year, we saw non-performing loans also climbing up to, I think, about between 23 to 26% thereabout, telling you that there is so high uncertainty in terms of people defaulting when giving money. And since banks are rational, they would also make sure that they charge you extra for this risk.
All right. Okay, Doc, we will break a lot of things down. I mean, you've spoken. I mean, you've gone ahead of me. You've spoken extensively about some of the things that I was actually coming to ask you questions on, and I think that is actually very good. We will break some of them down, but permit me to take you back. Now, we're talking about the Bank of Ghana. We're seeing that they've slashed the rate twice in just 2 months.
Yeah.
And now down to 21.5%. How significant is that compared to our economic history as a country?
Yeah. So it's very important, and you see, I mean, for the monetary policy rate, it is asymptotic to the inflationary rate. That's why I was referring to the data between 2017 to 2019. You realize that I didn't reference this because in 2016 we had a monetary policy rate of about 20-something percent. I think about 20 or 21%, if I'm right. But you saw that between 2017 to 2019, where you had an inflation was, I think, about 15.5% in 2016. But you realize that when inflation dropped to 7%, a single digit in 2019, you saw the monetary policy also dropping very sharply to about 13.5 or 14% thereabout. So monetary policy rate, like I said, it is a tool that is generally used to target inflation. So anytime inflation is on ascendancy, you see the monetary policy rate also climbing to what? To tame inflation. And in essence, in economics, what the monetary policy really does is to what? Is to mop up excess liquidity, because the other side of the increase in the monetary policy rate is that when the monetary policy rate is high, the cost of borrowing becomes high, or the cost of borrowing becomes expensive. But however, when you are investing, it becomes what? Very attractive, because, for example, if banks are charging, let's say, 25% for you to go for a loan, because the monetary policy rate is high, if you are going to invest, that in other words, if you are going to deposit your money in a financial instrument, or you want to buy a financial instrument as a form of investment, because the NPR is also going up, the rate of return is also very high. Now, it's one of the reasons why, if you take the Federal Reserve, for example, anytime the Fed increases the federal policy rate, or what we call the repo rate, you see the CD depreciating against the dollar, because invariably it is assumed that, holding all other factors constant, investing in the United States of America has become a very attractive, and a lot of it, given that America as a country is also low risk in terms of defaulting payment, in terms of servicing interest, in terms of servicing instruments, compared to Ghana, whereby we have to do DDEP and the rest. It is the likelihood of investors moving their funds out of Ghana to the United States to invest is very high. So that is why anytime the Fed signals that it is going to increase the policy rate, you see the CD depreciating, and you see the dollar having a strong edge over major currencies. So the same thing also happens within our economic space, that anytime you see that the CD is strengthened, ideally the CD is supposed to gain some strength if the monetary policy rate is also upwardly adjusted, and we've seen that over the years. However, anytime the monetary policy rate is also coming down, the negative aspect of it is that it means that, holding all other factors constant, investing in Ghana is not really attractive, because you are not going to get those higher returns that you were getting previously. And that would also induce, holding all other factors constant, people to move their money outside Ghana and look at other countries that are offering very competitive higher returns on investment. So it is a chicken and egg story as far as the monetary policy rate is concerned. But if you are looking at the domestic aspect of it, if you are looking at indigenous significance of reducing the monetary policy, then of course, once it is reduced, it is assumed that now Ghanaians in particular, and Ghanaian-owned companies, would have that luxury of borrowing from banks at a lower price, or at a lower rate, so that they can equally invest in whatever businesses that they are doing. And once they are investing and expanding, that is where they would have that room or propensity to also engage more hands indirectly creating jobs. So those are the do's and don'ts as far as the upward and the downward adjustment of the MPR is concerned.
I see, but why did the bank cut rates in moments like? Why do they cut rates in moments like this? I mean, what message is the bank trying to send with this decision?
Well, if you look at the decision taken, I mean, I think the decision is taken primarily on the fact that inflation is easing. We have inflation currently at about 13.5%. And for that matter, the central bank also thought it twice, like I said, because the overarching aim of the MPR is to target inflation. So anytime inflation is easing, then of course it makes economic sense that you also ease the monetary policy rate. Now, the most important question that you have asked, and I think it is implied, is the fact that looking at the macroeconomic output of the Ghanaian economy now, I mean, there are certain critical variables that determine inflation, and I mean, the inflationary rate and the determination of inflation rate over the years have become very questionable. Not just now, but I think for the past 2 years or so coming, it has become very questionable because if you see a product like crude oil, which is a major input in production. In fact, if you consider all facets of production, crude oil is a major input and determinant of pricing. Now, we've seen that for the past 2 or so weeks, even including yesterday, we've seen the price of crude oil climbing on the Ghanaian market. And here I'm making reference to the Ghanaian market and not necessarily the global market, because the global market has the price of Brent crude has been stable, I think about $65 and a few cents on the global market as I checked yesterday. But in terms of pricing window within the Ghanaian market, yesterday we saw oil in the host others of the BBZs increasing their prices at the pumps. So once prices are climbing, then it tells you that industries would also be incurring higher costs in terms of their production. And if they are going to incur higher costs, then that will also be passed on to the ordinary consumer. So rather than we expecting the fact that the monetary policy rate has been reduced and for that the cost of borrowing is coming down, however, because of the fact that a major input like oil is also climbing, you will see this not reflecting, and you will rather see the price of goods and services going up. Now, once price of goods and services going up, what does it translate? It simply means that all things being equal, we are going to have inflation also climbing, right? That is what it simply means. So it is important. I mean, the question that you asked, that why now? And for me, myself, I sometimes I get confused in terms of our microeconomic dynamics, because you expect certain things to play along certain range, but then you see one variable going the right hand, then you also see another variable going the left hand side, which normally makes our whole economic atmosphere a bit difficult to understand. Compared to a more stabilized economy like the developed world. Unlike Ghana, you do normally, even in South Africa, you see some of these trends moving in that direction. But in Ghana, you normally don't see things moving in that direction. So I think I would give the benefit of the doubt to the governor and his team, since they are in charge of the economy, that maybe they understand what they are doing. But looking at some of these critical figures as I am quoting them and moving away from an important input like oil, we've also seen the price of utilities, in particular if you've seen it, electricity, which is also a major input as far as production is concerned. Just this morning, I have seen that electricity price has been increased marginally by about, I think, 1.14%. That is the rate I am seeing. This is in addition to the previous, I think about 14 point something percent, and that we've seen, and about 4.15% that we've seen. So cumulatively, we've seen electricity go up almost about 18-19% thereabout. Within the first 9 months of the year. And this simply means that the cost of production is going to go high. Now, if this is the case, then it means that we don't expect inflation to come down. But however, we are seeing a sharp decline in inflation, which is amazing in any way. It's amazing considering these very important variables. I'm not saying they are the only variables, but I'm saying that they are major determinants as far as pricing is concerned. So
right.
if you are seeing a sharp appreciation in terms of these variables, and you are also seeing a massive disinflation, then it creates some sort of, speculation and that as far as certain macroeconomic figures are concerned. But let's give the benefit of the doubt to the managers of the economy that they know what they are doing.
Right.
I think we have to give them the benefit of the doubt that they know what they're doing. But considering the whole macroeconomic framework as I've outlined it, I think the major drop is somehow intriguing to see.
Because a lot of economists, I'm sure, I don't want to mention some names because they are not here, but a lot of economists have actually described that as a very dicey one. The drop that we're seeing, 21.5% in MPC, is quite, I've forgotten the exact word that they use, but the focus is that it is too much. It could have been a bit measurable, but like you said, let's give the governor the benefit of the doubt and see what happens. Doc, you please hold on for me. Let me announce our phone line just in case anybody wants to join the conversation. If you just tuned in or you're listening to us and you want to join the conversation, please, you can feel free to do that. Send us a WhatsApp on 0544321019, 0544321019, or you can call us on 03039566641, 03039566641, and then we'll give you the opportunity to share your thoughts with us this morning. We're streaming live on Facebook at ZFMGH, and also on YouTube at ZED Multimedia. When you visit these platforms, you can drop a comment and then we'll read them for you. This morning, we're talking about whether we're asking a question, and you're asking that will this policy rate cut to 21.5% actually bring real relief to borrowers? And my guest this morning is Dr. Frank Bannor. He's a lecturer at GIMPA and also the Director of Research at IERPP, which is the Institute of Economic Research and Public Policy. And he's helping us have this conversation this morning. Doc, so once I have you, I would love to pick your thoughts on exactly what is our inflation trends and all of that. Now, inflation has slowed to 11.5% in August, and that is the lowest in nearly 4 years. How sustainable is this trend?
Okay. So in terms of sustainability, I mean, it will depend on a lot of factors, and most of these factors are exogenous. So if you recall, like I gave the trend from 2019, thereabout, that we had one of the lowest form of inflation, I think about 7.3%. Prior to that, we had I think, about 7.8% in 2011 or 2012, thereabout. Yeah. So, I mean, but the 2019 one was about 7.3 or so percent. So that would be the lowest. So you see that in most instances whereby we've seen inflation go out of hand, like we saw in 2022, these are predominantly determined by exogenous factors. And one of these factors is the factor that I mentioned in terms of crude oil price. It's very, very important. Now, if you see in 2022, where we had inflation go up as far as 54.1%, you saw that if you look at the global market at that time, we saw crude oil price climbing over $100 per barrel. Fast forward, when by the close of the year, when we had crude oil price dropping to about $80 per barrel, we saw inflation easing from 54 to about 30-something% by the close of 2022. So this tells you the fact that it sends a signal that as far as our inflation rates is concerned, exogenous factors, and in fact, for that matter, the crude oil price also has a major impact. Now, another important factor as far as our inflationary rate is concerned is also the exchange rate mechanism, right? Now, when you see the dollar depreciating against, the CD depreciating against the dollar, it also sends you a signal that there's trouble ahead, because there is that pass-through effect, what I call the transmission mechanism. Because if I buy goods worth of $1,000 from the goods market, I don't have dollars because I'm a Ghanaian and I spend cedis.
Yeah.
I need to use cedi to buy these goods. Now, if I go tomorrow and then the same goods on the international market is $12,000, but however, the strength of the cedi has fallen, and for that matter, I will need to change more cities to get the same amount of $1,000, then it simply means that when I buy those goods and come to Ghana, I will need to increase the price, even though in real sense the price of the good has not increased on the global or international market. So the exchange rate is also an important determinant of the inflationary rate as far as Ghana is concerned. So if you are asking me how sustainable it is, how sustainable it is first will depend on the global crude oil or energy prices. If energy prices remain stable and we don't have any war coming in like we've seen over the past few months, the crisis within the Middle East, let's hope and pray that we don't see an escalation in the Middle East as far as the conflict there is concerned. We also don't see an escalation of conflict just as we are picking the signal now with Russia violating the airspace of NATO countries, and they also vowing that they will shoot down any Russian aircraft or drone that violates their airspace. Let's hope that such conflicts do not also escalate and becomes a problem, because we know that Russia is a major supplier of crude oil. We've also seen the United States and Venezuela also at each other's throats, right? In recent times, I don't know if a lot of Ghanaians are following that story. And Venezuela is also one country that also produces oil to the international global market. So let's just hope that all these factors do not get out of hand, which will lead to global crude oil prices, which is currently hovering about $65, $66, moving to a direction that we may not want, because once it starts climbing to 70, 80, 90, then it means problem for us. It means that prices are going to escalate, and when prices escalate, it simply means that anyone who is producing any product as far as even within domestic production is concerned would also be increasing his or her prices, which will invariably mean that inflation is going to go up. Let's also hope that the strength that the cedi has gained over the past few months against the dollar is sustained. I mean, like you were rightly saying, we've seen for the past few weeks that the cedi has been losing grounds against the dollar.
Yeah.
Let's hope that these marginal depreciations do not also get out of hand for us to go into the range at which will mean that people will now need to spend more to bring in the same amount of goods, and for that matter, they would also be forced to increase their prices. So the sustainability of these figures, that will be these microeconomic indicators that we are seeing, it's not dependent only on endogenous factors and policies, but however, external factors, what will happen outside the borders of Ghana, can also have a dire influence on the Ghanaian economy, and for that matter, the sustainability of inflation rate.
Right. Okay. I mean, I've picked your thoughts on that one. Let's also look at the growth rebound. I mean, we saw that growth rebounded strongly in Q2 with, I think, 6.3% year-on-year GDP growth. What is driving that growth, and how much of it is real versus statistical recovery?
Yeah. So in terms of the growth, so if you have seen, if you've paid attention to the data, especially in this year, you see that the real sector, I mean, which is a typical example, is the service sector, which employs, I think, which contributes about almost 40% or so of the total GDP of Ghana. You've seen that the real sector is seeing a marginal decline in terms of the year-on-year growth compared to the industry, manufacturing, and the mining sector, which over the past months has been the leader of growth within the Ghanaian economic space. And for me, it is good to see a rebound of growth. That is very, very important. It's significant to see that economic growth is not declining, but somehow it is marginally appreciating. That is very, very important. But the major question that you ask in terms of sustainability, in terms of creating jobs, will lie in the real sector. So I would love to see policies, and again, I would want to give this government a benefit of the doubt, because they are barely 9 months. I mean, after 1 year, then we can make a better judgment in terms of the policies and programs that they have put in place. So For now, I would say that let's give them the benefit of doubt. I mean, because as an economist, I know that policies have lagged, and this takes time to mature, and it takes time to kick in. So that's why I said that after 1 year, that is when we can really assess this government based on the economic growth figures that we are seeing. But overall, it is a good indicator that the Ghanaian economy is rebounding.
I see. All right, Doc. Let's come back to our conversation, and I would want us to focus on the transmission to borrowers. Earlier, you were talking about the fact that, I mean, in theory, once MPC comes down, then we should have the ripple effect in terms of our borrowing and all of that. Now, on paper, that is what it should mean, but historically, commercial banks in Ghana have not always passed this on. Why is that so? I know you tried to talk about it a while ago, but maybe we want to spend a bit more time to break it down better.
Yeah, so like I really said, if you look at the data, and paying attention to the data is very important. If you look at the data, we've not been doing well with NPL, that is non-performing loans, over the years. Now, when you have an economy whereby non-performing loans is a problem, then it tells you that banks are very careful in relaxing their interest rate.
Yeah.
I mean, we've seen over the years that the government had to come in and build certain banks. In fact, if you pick the 2024 budget statement, okay, a bank like, is it NIB, National Investment Bank, had to be built out because of non-performing loans. And this is huge sums of taxpayers' money that were pumped into NIB, right? So when you see such signals, and don't forget that we don't only have public banks operating. I mean, the public banks are even only few, but we have a lot of private banks operating within our economy. So this sends signals to the private man that, look, if I don't tighten the knot and I try to loosen the knot, and I find myself in crisis or bankruptcy, who will go to bail out the private bank? And that has been the question, and that is why we saw within the banking sector cleanup that the government had to collapse and merge a lot of banks or consolidate them. I mean, that is appropriate, but had to consolidate these ones. So these are the signals that exist on paper, and the banks themselves have these data on their tables. So given these signals, banks are very cautious anytime the NPR is relaxed, because anytime the NPR is relaxed, if you are not careful and you also relax the interest rate, it has the propensity to induce any citizen to also come and apply for loans. And given the fact that I mentioned earlier, given the fact that in Ghana, we don't really have a database which will determine the risk level of consumers. I remember the previous government tried to introduce the credit scoring system, which would, to some extent, have been a gauge in terms of assessing our credit worthiness. And the credit worthiness invariably tells our risk level. So if you, for example, your credit score is 800, then it means that you are more credit worthy. If my score is 200, then it means that I am not credit worthy. So if you and I approach a commercial bank for a loan, you have to get a loan at a very low interest rate, whereas I have to get a loan at a very high interest rate. But given current circumstances and conditions, such indicators do not exist, or they are not available at all. So the credit worthiness of individuals who are actually looking for loans is something that the banks don't have. For example, if you consider the Ghanaian economy, let's just break the Ghanaian economy down. Now, you will realize that the small, micro, medium enterprise, the SMMEs, contributes about 80% of GDP. Now, out of this, the 80% of GDP that the SMMEs contribute, you realize that the SMMEs also have a chunk of what I call as the so-called informal sector of the economy. Most of these people who operate within these sectors are people who hardly even keep records of their own trading activities. They don't have any database to back the activities that they do. And most of the people who need credit are some of these individuals or some of these small businesses. Now, if you consider to the big giants or the established institutions, It's very, very easy to identify them. You can identify their plants. You can identify their offices. And these are assets that you can easily liquidate in terms of they defaulting their loans. But if you consider the SMEs whereby someone is selling on a tabletop, sometimes someone is even selling on the hair top, for example, how do you reap back these money? Should people in these business, I'm not saying these people in these businesses should not be given money. That is not what I'm saying. Now, the point that I'm making is that the risk level is very high within that space.
Right.
And because the banks know that the risk level is very high within that space, they are reluctant to actually reduce the policy rate as far as giving loans to most of these entities are concerned. So you see that for the well-doing businesses, the established entities and businesses, they can actually approach the commercial banks and actually negotiate for favorable terms as far as interest rates are concerned. But if you consider SMEs, which are a chunk or which constitute the majority of the economy, they don't have that leverage, and for that matter, they are forced to go in for loans at a very high rate, which also do not favor their production outcomes. So there, the risk level, which would accommodate people not to pay back the loan or to default, and thereby increasing the non-performing loan portfolios of banks, is one of the major reasons for me, as far as the data is concerned, why anytime theoretically the NPR is reduced, you expect commercial banks in general to reduce their lending rates. However, we don't really see this happening, as I pointed out to when we had monetary policy coming to, I think, about 13.5 or 14% thereabout. We didn't see it transforming into very cheaper lending rates in Ghana.
Yeah.
And that has been the case, like you rightly pointed out. And I think all this is due to the fact that the risk or the uncertainty that exists has not been mitigated. And so far as we don't put in policies and measures that will mitigate risk and uncertainty, I doubt that commercial banks, being as rational as they are, would also be motivated in driving down lending rates drastically, as we've seen in the cuts in the monetary policy rate.
I see, Doc. Some people actually say the problem is structural. I mean, banking in Ghana is simply expensive to run. Do you agree?
Well, to some extent, it is true that our problems have been structural. In fact, since independence, we've not been really been bold enough to find antidotes to some of these issues. And I shudder to say that in many attempts, we put these blames squarely at the doorsteps of politicians. And I have made this point. It doesn't matter which government is in power. I have made this point. That is something that I disagree. I tend to disagree. Yes, politicians can take part of the blame, but we citizens should equally take part of the blame. Let me take you back to 1957 when we won independence. So Ghana won independence in 1957 with Dr. Sadifo Nkrumah. Now, 2 years after independence, which is 1959, Ghana recorded its first fiscal deficit. In other words, we had expenditure exceeding what? Revenue. Which simply means is that Ghana had to go to the international market to start looking for money to beg for loans. So if you recall, it's one of the reasons why when Osadifo wanted to build Akosombo Dam, Ghana literally had to go and beg international agencies. And for that matter, we saw one American entity offering to provide the money and then came to establish VACO. That is the story behind VACO. This is simply because of the fact that we did not have enough money in our treasury to be able to cater for our own development. And that has been the case over the years. Now, so anytime you are a country that cannot raise enough domestic revenue by international measures, which is deemed by these rating agencies, among other things, you are considered as a high-risk country. Now, if you are a high-risk country, meaning that the propensity for you to default on your loans and financial obligations is very high, as we've seen in 2022, 2023, and some years back down history. It means that it's very high. Now, once this becomes the case, then it simply means is that if you are even a business in Ghana and you want to raise capital from international capital market, for example, maybe the New York Stock Exchange or the London Stock Exchange, or even the JSE, the Johannesburg Stock Exchange, which is the biggest stock exchange on the African continent, you would still be getting this capital at a very expensive or exorbitant rate, which of course will force you to fall on domestic capital. Of course, when you fall on domestic capital, because domestic capital is issued in your local currency, though the interest rate is high, but at least it is affordable because you are not going to service these monies in foreign currencies, which gives you some form of leverage and relief. However, at the same time, because of the uncertainty that also surrounds the utilization of these capital that most people look out for, because you see, one of the things that people will go and borrow for is the returns that they expect to get out of it.
Yeah.
Now, in many times, people borrow and spend on government-run projects. That has been the case in the Ghanaian economy. You don't really find people borrowing to create real businesses and jobs that are independent of government. Either the person is taking a loan to go and take some government building to build, construct, so that government will pay back the money to the person. Either the person is taking a loan to go and construct a hospital, to go and construct a school, to go and construct teachers' bungalows. I mean, you can name, the list goes on and on and on and on and on. So in everything that we do, it is somehow not independent of government. And because of the fact that government over the years has also been cash-strapped, that is the reason why I brought in the point of 1957 to 1959. Now, because government is also cash-strapped, it simply means that the propensity for government to default in payment of some of these investments that private sector also make, depending on government to repay them, also becomes a problem, and thereby lead to what? The default of these payments to most commercial banks within our macroeconomic jurisprudence. And once that happens, it also creates that uncertainty among banks, and for that matter, they also keep adjusting the policy, the lending rate, or even when the MPR is eased, for them to also follow the same trend and ease their lending rate. They also do not do that because of the fact that they still don't trust that consumers would be able to pay back loans given to them on time. So if you are asking me that whether our problem is structural, that is the history and the interdependence of our financial system as far as of the inadequacies in our economic structure is concerned. They are somehow linked. So until we be able to decouple this and find solutions to the bigger picture, I think this other side of the equation would still persist.
It's a very, very dicey situation. Doc, so please hold on for me. Let me just announce our numbers one more time in case anybody wants to send us a message. If you want to text us, please feel free. 0544321019, 0544321019. You can send us a WhatsApp and then we will read your messages for you. You can as well call us on 03039566641, 03039566641, and share your thoughts with us. We're streaming live on Facebook at ZFMGH and also on YouTube at Z Multimedia. You can visit those platforms, drop a comment there, and we'll read them for you. This morning, we're talking to Dr. Frank Bannor. He's a lecturer at GIMPA and also the Director of Research at the Institute of Economic Research and Public Policy. And we're asking whether the policy rate cut to 21.5% will bring some real relief to borrowers. And we've said a lot of things, but we still have a few things to cover before we go. Doc, let me come back to you now. Now, what role does government or what role do government borrowing and T-bill rates play in keeping the lending rates high? Does it play any role, first of all?
Yes, it does. Yes, it does.
What role does it play?
In terms of government borrowing, like I was talking about the fact that commercial banks would give monies to people who would not necessarily want to give monies to people who are high risk. So I gave you the scenario between big businesses. I don't want to mention any name of business, but we all know the big businesses in Ghana, and then certain micro, small, medium enterprises in Ghana. If I approach a commercial bank for a loan, and one of these big entities approach a commercial bank for a loan, the probability that that entity will get a loan over me is very high because I am within the high risk framework. I am deemed more high risk or riskier compared to the business entity concerned. It's the same way if government approaches a commercial bank for loans. I mean, in terms of these government borrowing through treasury bills, they are all forms of borrowing, right? The treasury bill is a short-term borrowing instrument that government issue, which is issued on behalf of a government by the BOG, and then commercial banks then sell it out to consumers who would want to procure them. So invariably, it is the same deposits or the same liquidity that the government will mop up from the economy from consumers. And it's this same liquidity that a consumer would ordinarily, had it not been the instrument that has been issued via what we call T-bills, then this consumer would have either deposited the money in his account or would have invested in any of the various investment instruments that the commercial banks possess. And that is where the commercial banks will then mop up this excess liquidity and also give it out to loans to individuals who are looking for funding to invest in their businesses. So that is the reason why anytime government undertakes excessive borrowing, it tends to crowd out private investment. What it literally means is that because government has taken out all the liquidity, there's little or no liquidity available for you and I to go and borrow from the bank. So now what it simply means is that if the government is actually paying a higher premium or a higher rate for this liquidity that it is taking from the system, then of course, if you and I want to go to the same market and compete, we cannot be paying a lower rate than what the government is prepared to pay. So anytime government is paying a higher rate, it also has an impact on you and I because we cannot compete with government. Because mind you, irrespective of all the shortfalls of government, there's one phrase that has become synonymous over the years, that government never dies. When NPP left, NDC has come. And the liabilities of Ghana is inherited by the NDC. The NDC can never say that because they did not borrow certain monies, so they will not pay. That is not the case. The same way when the NPP also came, there were some liabilities that they also inherited, and they also did not say that because they did not borrow those monies, they will not pay. So it is certain that government never dies. It means that so far as the world has not ended and we vote for new government to come into office, government obligation will continue to be served. And it's one of the reasons why even within the T-bill framework, the government always borrow to service maturing T-bills. That is what is normally done, to service maturing T-bills. And the rest then goes into capital expenditure, among other things. So government borrowing actually has an impact, and also depending on the rate at which the government is borrowing. But then it is important to lay this extension. You think the T-bill that is issued by the BOG and then the T-bills that are issued by the Ministry of Finance, they are two different instruments, and both instruments have two different objectives. So, for example, if you see the T-bill that is issued by the central bank, the main aim of that instrument is what? Is to reduce inflation. So the main aim of that is to mop up excess liquidity from the economy. So anytime you see inflation going up, or even when you see the Bank of Ghana making some payments through fiscal authorities, you see that within the next month or so, the BOJ will issue those T-bills so that it will mop up those excess liquidity. So if you have followed the story very well, you see that the rate at which the Bank of Ghana pays for its T-bill is very high compared to what the rate at which the fiscal authorities, for that matter, the Ministry of Finance pays, right? Currently, the Ministry of Finance is paying something between, I think, 13-14% thereabout. But the last time that the BOG issued its treasury bill, I think it was about 20.5 to 21.5. I think it was plus or minus 5% thereabout. That is what we saw. Now, the main aim is that for the BOD, it is to mop up extra liquidity. So if I have money and then I'll be tempted to spend in the economy, the BOD would then offer me a high rate, which will be an incentive for me not to spend that money, but rather to invest in an instrument. So that is what the BOD does. But as far as the government of Ghana through fiscal authorities, the Ministry of Finance is concerned, they normally issue these T-bills as a form of raising money to pay back existing government instruments that are maturing, and sometimes the rest they put it into capital expenditure to also cater for other expenditure like recurrent expenditure like salaries and so on and so forth. So that is the aim of these instruments. But overall, if the government is borrowing more, like I said, it simply means that there will be little or no liquidity available for you and I to borrow. And once there will be little or no liquidity, it will simply mean that the price will go up. This price here referring to the interest rate of at which we are supposed to borrow. So it may not necessarily mean that the MPR has come down, but the fact that a lot of people are chasing for few liquidity or cash available so that they can also have access to these cash to invest and expand their businesses. Of course, we would also have the interest rate within that range also seeing an upward adjustment.
I see. Doc, earlier you were talking about some policies that we can put in place. I mean, you said the Bank of Ghana needs to put in certain policies. I'm going to come to you on that one. But could a stronger competition among the banks and maybe microfinance institutions force the rates to come down in any way?
Yeah, I have been an advocate of having a competition policy in Ghana. That is very important. But within the financial sector, I think the rates have always been competitive. I don't think there is any one bank, 2 or 3 banks that charge the same rate, if I remember, as far as I've had the opportunity to look at data. I think the rates have always been competitive. And these rates have been informed by, one, the policy rate, they're very important. Supply and demand, they're very important. I mean, in terms of what government wants, in terms of what consumers want, in terms of what government is willing to pay. And in most cases, government is willing to pay above the market price, which is the market interest rate, which simply means that banks will be more interested in lending to government. So if you look at, I think there is this report, I've forgotten the name of this, there's this report on the banking sector that looked at the commercial bank investments over, I think, from a period of 2014 to, I think, 2020 or 2022 thereabout. Yeah, I think 2022. So you see that if you read that report from 2013, 2014, 2016 thereabout, you see that the total investment as far as government instruments are concerned, we're doing something roughly within the range of 30%. But from 2016, 2017 coming, you realize that commercial banks all of a sudden increase their lending to government, that's in terms of government instruments, to a little over 60% thereabout. That is telling that it's almost about 100% increase over the years. That tells that over the years, government has really been inducing the market by paying very competitive premium to commercial banks as far as their instrument issuance are concerned. Now, once this becomes the baseline, it will be very, very, very difficult for any commercial bank to say we are giving loans or instruments to businesses and consumers below this rate. I mean, at the end of the day, banks exist to make money, right? Yeah. They exist to create money, and they can only create money by what? By lending out money to people who are ready and able to pay the rate at which will keep them going. So it becomes a very dicey situation here that not necessarily the competition policy will be important as far as the financial sector, but I think a competition policy will be more important to the businesses aspect in terms of pricing of products. I think that is where it is very, very important. But within the banking sector framework, I think the baseline or the floor has been regulated and set by the BOG, which is through its monetary policy rate. And for that matter, you cannot charge anything below the monetary policy rate. So, for example, today that we are seeing the monetary policy rate to be 21.5%. Given that this is the monetary policy rate, you don't expect any bank to give out loans and charge 15%, of course, because the rate at which you are getting the money from the central bank is 21. So how do you then charge 15%? It means that you'll be making losses, and how do you make up for these losses? So that aspect has been regulated very well by the central bank. Now, what is important that I think that we need to be looking at is in terms of the marginals, the additions that come atop the NPR rate. And that is where it is critical. That is where some banks are overdoing it in terms of the risk levels, right? So you see NPR to be maybe 21%. You see inflation to be maybe 13.5%, which obviously tells you that the rate, this inflation is setting in. So if you are giving out money, you are certain that the money will not depreciate that much over the years, and for that matter, you do not also need to charge more as far as depreciation, which is primarily determined by inflation, is concerned. So what you should be looking at is this factor of risk, the uncertainty of paying or not paying back this loan, and also the fact that your also business administration and costs are concerned, because you also need to pay your workers and so on and so forth. These are the critical factors that you may need to consider in pricing your interest rate. I think that is the part that maybe if the BOD could come in and set certain criteria, and it would be important that in doing these criteria, we look at mitigating risk, and that is why I think I am of the view that a policy like the credit scoring system should be re-looked at it. It doesn't matter which government wanted to implement it, but a credit scoring system is one of the things that I think if we are going to look at it and rightly implement, then we are going to have a mitigation of this risk, which guarantees that even when even when inflation rate is dropping, you still find commercial banks charging exorbitant rate because they are not sure whether you will pay back this money on time or not. I think that is the part that we should be more focused on in using policy to tackle.
All right, Doc. Maybe we'll touch on a few things, but I was going to ask of other reforms that you may want to propose, but I think you've covered that, isn't it? Or are there some other things you may want to mention?
Yes. So in terms of reforms, I think we've had enough reforms over the past years. I think what we need to do now is to be intentional about the things we do. Look, I mostly tell my students that development is intentional. You don't sleep and wake up and see development. No.
Yeah.
All the countries that have had development, they were intentional about it. And development also takes time. It's very important that we get to know this. Economic policies necessarily do not mature over one period, 1 year period. Sometimes it can even take 10 to 15 years, 20 years, depending on the lag of the policy that we will actually see progress. But what is important is that we must be deliberate and intentional about policies and pursue it irrespective of government changes. That is the only way we can break some of the caps that we are seeing. Because if we implement credit scoring today, I bet you it will not actually mitigate the issues I'm raising this morning. But one of the things that I'm so sure about is that within the next 5 to 10 years, we would have mitigated the issues that we are talking about today. So that is the fact that when I talk about we being intentional about policies, and we also not being political with government policies, it's important that we depoliticize policies out of economic decisions. It's very important. Economic decisions and politics don't mix. Of course, politicians mostly implement economic decisions. But once you politicize economic decisions, it doesn't really give you the much intended result that has been earned in certain countries, as we are all witnesses to. So it is important that we become very intentional and deliberate about the things we want to do to change the structure of our economy. Right. Another most important thing is the fact that we should be able to raise enough domestic revenue. Now, how do we do this? It means that we have to create enough incentives for the people, not just foreigners. You see, when we talk about raising revenue, people think that we should all be looking at FDI, foreign direct investment, by relaxing our investment laws so that people will come in and fleece us. That is not the case. But when we are looking at investment, you see, the best or the most important capital that we have as a country is the citizens, you and I, and nothing more. It is not the natural resources that we have. So, you see, most of these advanced countries that have been able to develop even with that natural resources, is the fact that they have been intentional about their citizens, they have empowered their citizens, and their citizens are the ones who are paying for the development that you and I travel to these countries and see. It is not foreign direct investment that is paying for that development. It is taxpayers' money that's paying for that investment. But when you look at the Ghanaian system, we have a system whereby the last time that I perused the data, we had barely 2.5 million of a population of about 34 million that pays tax. So invariably, it simply means is that a chunk of the projects that we need to fund will be paid by foreigners. When I say foreigners, I mean that foreign direct investment. through either we are going to issue bonds, among other things, or we are relaxing our laws so that people can come in with even $100,000 to invest and recoup back their investment in millions of Ghana cedis and go back home. That is certainly what we are creating. And we cannot continue to live our lives to govern as a country in this manner. We need to be intentional about development. And this is why it is important that governments over the years, including the current government, deliberately resource and empower Ghanaians to the extent that Ghanaians will be able to produce and sell in larger quantities. That is the import substitution that we've been talking about, so that we'll be able to raise enough tax revenue. Again, another form of incentivizing Ghanaians is through a credit scoring system. My brother, look, there has been the talk that if a mason works and takes 100, let's say 10,000 Ghana cedis, he doesn't pay tax, and we are always connected to it.
Yeah.
But you and I, the work that we do, we may not be earning that amount of money, but we pay tax.
Yeah.
Even if you earn 2,000 Ghana cedis, you pay tax on it. A mason or a carpenter goes to work for less than 8 hours, he takes 10,000 Ghana cedis and he works home. Now, if there is an incentive for this mason for him to pay tax, he would pay tax. And a country like South Africa, if you go there, you see people in queues trying to file their tax return.
Wow.
Why is it so? Because there is an incentive when you file your tax returns to show that you are paying tax. There is an incentive that you get. Those are the incentives that I think policies deliberately need to create. And the examples are there. So many of them are there. So that people will be incentivized to pay tax. If a credit scoring system will allow you to have access to certain capital goods, of which you may not necessarily need to pay upfront, then of course, if I am a carpenter, I would want any payment to pass through my mobile so that my credit will be built, so that I can equally also walk to a Toyota showroom or any vehicle assembly plant and say, look, given my credit scoring, please give me a car and give me a contract to pay back in 5 years. And you will get it. These are the incentives that you create for people to what? To declare themselves and to open themselves up in paying taxes. And these are the incentives and policies that I am of the view that government today and government tomorrow should pursue so that we can reverse the losses that we've incurred as a country as far as our development architecture and framework is concerned.
All right, Doc, thank you very, very much. Maybe just before we go, so if inflation continues to ease, do you expect the Bank of Ghana to cut rate even further in the next few months, maybe 6 to 12 months?
Yes, if inflation continues to ease, and like I rightly said, if global uncertainties are also simmered, then of course you would expect the BOU to cut the rates further. But however, if global uncertainty, especially around energy markets and energy prices, become highly volatile, then of course I do not necessarily expect them to cut the rate. Even if they would cut the rate, it will not be as massive as what we've seen last week.
All right, Doc, thank you very, very much for your time, and thanks so much for spending your morning with us. Really, really grateful to you this morning.
You're most welcome. My pleasure.
All right, so please do enjoy the rest of your day. Hopefully we have several other conversations in the coming days.
Thank you so much.
All right, thank you very much. Okay, so that was Dr. Frank Bannor. Dr. Frank Bannor is a Director of Research at the Institute of Economic Research and Public Policy, and he joined us this morning for a big roundtable discussion. We're asking a simple question: that will the policy rate cut to 21.5% bring real relief to borrowers? And Doctor has said a whole lot. He says that it takes a lot of things to be able to see the real return. There are some reforms that we need to do as a country, and it's actually a whole lot that we have to do. If we are unable to do that, then we shouldn't expect any cuts in our borrowing cost as a country in the coming days. And so that's how we wrap up this morning on the Business Breakfast on ZED right here. And we heard the numbers, we heard the history there, and the hard truth about policy rates, and also lending in Ghana. Now, one thing is clear: the Bank of Ghana may have fired its shots, but whether the bullet reaches households and businesses depends so much more on the policy rate. I mean, more than the policy rate alone. And my hope is that this conversation has not only given you some clarity, but also stirred some of the questions you'll be asking your banker, your business partners, and even yourself in the days ahead. Thank you very much for staying with us, and a big thank you to our guest, Dr. Frank Bannor, for helping us unpack this. My name is Nii Trebi Hammond, and as always, it's been a pleasure spending this time with you. Please stay safe, stay hopeful, and let's keep the conversation going. And when you think Ghana, think ZED. I'll see you all